right. Good afternoon, everyone. Welcome to Lunchtime Topics. I'm Kate with the Creative Coast. Today is Wednesday, January 27th, and Ned Duffy from SCORE is here with us today to talk about knowing your numbers. Ned is retired from a successful 42-year career in commercial banking. He moved here to Savannah in 2018, and he immediately volunteered for SCORE, which is an organization that is dedicated to providing aspiring entrepreneurs and small business owners with free professional business mentoring services and educational programs and resources to help them successfully start and grow their business. So Ned is now the treasurer of the award-winning Savannah Chapter and is a certified mentor specializing in all things financial and budgeting, as well as overall business plan development. He has experience with broad spectrum of business industries and is skilled in areas of commercial real estate management and development. So Ned, we're so glad to have you here today. I'm going to go ahead and turn the floor over to you so you can get started. We're excited for the presentation.
Thanks so much, Kate. Today, what we're going to do is hopefully demystify the process of having an entrepreneur do their own cash flow projection. That's our overall objective, stated in a very short, clear, concise sentence. First of all, I thought I'd review who SCORE is. A lot of people don't have this information. SCORE is the largest provider of free business mentoring. We here in Savannah have a group of 46 mentors. That's a number that's changing all the time because mentors are coming and going and so forth. But today, we have 46 mentors on our staff. We service a 7-county area going as far west as Statesboro and down south as far as Brunswick. The Savannah chapter of SCORE. We also, we're an educational organization. We do workshops and presentations like this. SCORE was formed in 1964 as an affiliate of the Small Business Administration. It's now an more or less independent. We're still affiliated with SBA, but we operate as an independent arm of the federal government. And we have 240 chapters. We're a nonprofit. We have over 10,000 volunteers. All of our mentors are volunteers. No one is paid. We have the mentors are all successful business owners, entrepreneurs, and we annually give over 4 million hours of free mentoring services each year. 45 mentors, it's actually 46 now in Savannah. In 2020, we won a diamond level chapter designation. That meant that we were a premier educational group recognized by certain KPIs within our group organization for 5 years in a row. It's a very, very small group of national chapters that achieve that level. The year before, we were mid-market chapter of the year nationally. And we have in the past achieved designations like outstanding client education programs. SCORE services are, as you see, we have online workshops like what I'm doing right now. We do a lot of one-on-one mentoring. And you can go to our website, the national website, score.org, and click Find a Mentor to select your mentor. You may know some of our local clients. These are all businesses in Savannah that are were at one time SCORE clients. They include Parker's. You see a picture of Mr. Parker there. Just look at the logos. They're all businesses that you probably know, and hopefully you are customers. So financial planning, why are we here today? We're here because we want to determine financial viability for the business. We want to measure the capital that's required to get the business set to open and then to launch and operate. There are two components to the capital that's required to start up a business: pre-opening and then the operating losses that are generated until you achieve break-even operations, the startup operations. it helps the business owner allocate capital and organize the financial end of what has to be done to start a business. It helps measure the performance once the business's doors are open and things are operating. And if you're going to attract any potential lenders or investors, capital support for the business, you have to have a well-documented financial track record. Every well-managed business operates under a budget. So you do your business plan when you start up, and you have a budget, and we're going to go through that process today. But in addition to that, once you're open and operating, every year you're going to do an operating budget. So this is a process that you really need to start and be comfortable with if you're going to be serious about growing and nurturing your business. We're going to review the key definitions that you need to know. This is accounting lingo, as I call it. It intimidates people, but what I want to do is demystify it. There are two kinds of costs in a business. You have variable costs that will be incurred as sales are made. These are things like labor costs, the cost of a good, if you're selling an item, the inventory, the cost of the inventory that you're selling. If that inventory gets packaged and shipped, those are costs that you will incur every time you make a sale. Variable costs will fluctuate with your revenue levels. And then fixed costs are usually beyond fixed salaries, occupancy costs. Occupancy being rent, insurance, utilities, and they are fixed no matter what your revenue levels are. Those two components are the two pieces of the financial projection on the cost side, and you have to account for everything within those categories. Your income statement. This is also sometimes called an operating statement. It is called an income and expense statement, a profit and loss statement. Those are all terms for this same thing. It measures the economic activity over a defined period of time, either a week, a month, a quarter, or a year. It shows levels of sales or revenue if you were a service business, less variable costs, the costs that are a percentage of sales in our projecting process. Those are the costs that go up and down with revenue. And then the fixed costs, which are level, those are the rent and the insurance, the costs that we all know we have to pay whether the doors are open or not. And then you arrive at the net profit. The gross profit margin, this calculation here, in this example, the gross profit margin is $4,000 on $10,000 in sales is 40%. That is also referred to as the business's markup. So you've got a product or a service that you mark up to resell. The gross profit margin is the markup. And the break-even point, this is an important calculation. Down below, you'll see that the break-even is fixed costs divided by the gross profit margin. Percentages expressed for mathematical purposes are in decimal form. 0.40 is the same as 40%. If you divide 0.40 into $3,000 in fixed costs, you get a break-even sales of $7,500. Those are important concepts that you need to know as we proceed through the financial projection model. The accompanying financial document in a business is called a balance sheet. We're not going to talk a lot about this today because in terms of operations, the balance sheet usually is not a critically important document. The balance sheet is a listing of what the business owns and what the business owes. And it is as of a specific day. It's not a period of time. It's a snapshot of what the balance sheet is for the business, the ownership and liability listing on a daily basis. Usually it's a month-end date because it accompanies a financial statement, an operating statement that is for a month. So if you want one for January 31st, next Monday, your operating statement would be for those 12, the first month of the new fiscal year, and the balance sheet would be at month end. The difference between debt and assets is net worth. If your debt exceeds the cost of your assets, the assets are listed at the lower of cost or market. If your liabilities exceed your assets, you are bankrupt on paper. It means you owe more than what you own. Any questions so far?
I don't think so.
The break-even point we just mentioned, that's when cash is equal to cash outflow, the sum of variable and fixed costs. The gross profit margin is sales less variable costs. And again, net profit margin is sales less all costs, including taxes. Those are the ends of the key definitions. If you can master those simple concepts, you're now ready to start and put together a financial projection. It's an important, you have to be able to determine how the business is going to be profitable. Is it viable? One of the things you want to prove in this process is whether the business you're contemplating is economically viable. Is it going to be able to support you? Is it going to be able to attract investment capital so it can grow and be scaled and be leveraged? In the financial tool projection process, you're going to have the concept of negative cash flow where expenses exceed inflows. That's normal during a startup. And then positive cash flow is obviously when things have turned for better and the revenues exceed expenses. Now, the sales forecast is one of the hardest parts of doing a financial projection, and it's based upon assumptions. I have probably reviewed as a banker when I was working, I bet you I saw at least 1,000 business plans during my 40 plus year career. And I got to the point in the process of initially looking at them where I would immediately pick the plan up and go to the financial assumptions page in the business plan. I didn't even want to know what they did. I wanted to see their financial assumptions because that's my test as to whether the business plan makes common sense. I used to call it the Sniff Test. And the assumptions have to be derived from market-based data. In other words, you have a market of a certain definition, usually dollar amount and size, sales, or there are a lot of resources available for you to determine what the market is. Then you have to come up with the plan to obtain a portion of that market in terms of your projected sales. And the rate that you are projecting you will obtain and the rate of growth of that portion are the reasonableness tests that the reader of the financial plan is going to look at first to make sure that it's not pie in the sky. I remember a business plan I saw once that said the national market is $4 billion. And in, it was the state of Maryland, I believe. And it said the Maryland size for the market is $900 million. We will, in their first year, we will obtain 0.18% of that market. What's that based on? It's a pure guess, not real world. You might call it the dartboard theory of financial projection. You might as well be using a dartboard because it doesn't have any real connection to reality. So the sales forecast is a key component, and the assumption in the financial section, the list of assumptions have to detail what the logic is behind the numbers. Same with the cost assumptions. Certain costs you're going to know. The fixed costs are the easiest ones to ascertain. Rent, you're going to know because you're going to sign a lease. You're going to know insurance because you can get a quote from your insurance agent. Though there are certain costs that can be clearly defined. Others are going to be variable because they're going to vary with sales. Labor is one of the hardest ones to estimate. How much labor do you need to generate any sales? But if you make reasonable assumptions with the number of employees, what they're compensated at, you can come up with all of this number. And then, as a result of doing all of this, you can determine through the assumptions how much the business is going to take to get started and go through its break-even process. The cash cushion has to be sufficient to do all of that. Pay the pre-opening plus the operating deficits during the ramp up to break even. And if the cash, if you run through all the cash, you're broke, you got a problem, it's decision time. You're going to have to try and find some more capital or do a pivot and see if you can decrease costs and see if you can move the break even down to a lower level of sales. That's why you need to monitor the financial condition of the startup at least on a monthly basis. And most people actually do it every week. It's got to be done very carefully and with great attention to detail. For those who are visually inspired, here's a graph of what it is we've been talking about. On the left-hand margin, you see the revenues, and on the bottom, you see time, number of months, let's say, that the business is operating. Fixed costs are detailed at $100 a month, and revenue grows at the rate as specified down on the bottom. Negative cash flow in the beginning. Sometime in the 6th month, break even is achieved, and after that, positive revenue is the result. Net revenue is the result. Now we're going to spend some time on this page because this is where the rubber hits the road. This is an example. Now, don't concentrate so much on the actual numbers because they're very simple numbers so that we can not get too hung up on the math. Concentrate on the concepts of what we're talking about. Sales, variable costs, and fixed costs. How do they all interrelate on this projected operating statement or cash flow projected statement? You have capital. You've determined that you need $250 to get the business to its break even. You've already got the doors open. You've already paid for fixturing or whatever you have to do to get the pre-marketing. All of those expenses are already paid. Now you have $250 to get the business to its break even. In the first month, your sales are $100. That gives you total cash of $350. From that, you pay expenses. Variable costs at 60% of sales. So 60 is 60% of $100. And then you subtract your fixed costs, which are $80 every month. So your total costs in the first month are $140. You only had 100 in sales, so you lost $40. And that gives you less ending cash. The ending cash of $210 goes up to month 2 as the starting cash, and you go through the second month of operations. This month you sell 120. That you had to pay variable costs of, again, 60% of sales. 60% of 120 is 72. Fixed costs, total costs are 152. The net loss for that month was $32,000. You've made progress from month 1 because your loss is $8 less. Third month, sales go up to 150. Fourth month, they drop to 120. Maybe you are in the springtime of the business in terms of sales cyclicality, and then the fourth month, it's a slower month. But to demonstrate the impact of what happens when sales go down, you go back to the 60% of sales at $72.80. So you have another month that is the same result as month 2, a loss of $32,000. But your cash is still running out. Your cash is now down to $126. So you got to keep an eye on this and make sure you keep sales going up. They dip to 120, you get them in month 5, you get them back to 150. And then in the final month, you finally get sales to $200. And that is where your break even is. This is a typical cycle of what a new business operating result would look like. The numbers obviously are going to change from one business to the next, but the dynamic of how the cash flow works and how you need to have a nest of cash to underwrite those operating losses. This is a very typical example. So to project the income, again, we go back to that because that's one of the keys. You want to analyze daily traffic patterns for, let's say, a retail business. How many people are going to potentially be customers? How many prospects come in for the first time and repeat customers? How many? What's the determination of that conversion rate? These are all things that go into the description of your assumption in the business plan. You're documenting for the reader of the plan what your assumptions, what your logic is in putting the numbers together. From all of those assumptions, you determine the average revenue per sale. That's a key number, your transaction value. Very important for doing the math. And then you can thereby estimate your revenue by how many sales are you going to make per day, per week, per month. Let's take an example of a restaurant. You're going to have lunch sales and dinner sales. They're going to have different values. How many lunches are you going to sell a day? How many dinners are you going to sell a day? Are you going to be open 7 days a week or 5 days a week, 6 days a week? If you're open every day, then you max out your financial capability. If you're closed on Sundays or Mondays, you're only 6 days a week. It affects the assumption of revenue. All of those things have to go into the construction of the projection. Let's take a specific example, something that we all know and love in Savannah, a coffee shop. There are a plethora of them to choose from in Savannah. Ours is going to be called a Cup Above Coffee Shop. Here is the data that we need to start the projection process. The shop is located in an intersection with 15,000 vehicles a day going by. We're going to assume 15% of those people are coffee buyers. They purchase at all different shops. You're going to assume that you get 10% of that 15% in your shop. Is that a reasonable assumption? It's not overly aggressive. It's something that would be fairly easy to measure. And I think it could make sense with the proper marketing, with signage and some other things to try and enhance the chances of getting that number. So you're going to assume 50% of all the first-time customers that come in the door become repeat customers. That might be a pretty reasonable assumption also. You understand it's the sniff test that I talked about? These are the assumptions you need to put in writing in your business plan to sell the numbers that you're trying to convince the reader as being realistic. So your average revenue per sale in this new coffee shop is going to be $3 per sale. Total daily traffic, 15,000. Market potential, 15% of that total are buyers. You're going to capture 10% of those buyers in your shop, or 225 customers. 50% of them will be repeat customers. The average sale per customer now, this is important, this has changed, it's going to be $6 per customer. That's a cup of coffee and a donut, or a Danish. So the average sale per customer, again, one of the key components in this process, does it make sense? And then use it to do the math. Daily revenue is 113 daily customers at $6. That comes up to $678. Monthly revenue is $20,340. You got your first month's sales. Voila. Was that complicated? No, it was constructed on step-by-step assumptions to come. And the math of this is third grade math. It's addition and subtraction, a little bit of multiplication and division. You have to be able to calculate a profit margin, but it's third grade math, basically. It's not complicated. Anybody can do this. I want to go back. I don't want to talk about that just yet. So I hope that this has demystified some of the scary part of, I don't know how to do a financial projection. If you sit down and make your assumptions, you can do the math. You can also use a SCORE mentor to help you walk through this process. This is where a mentor can come in very handy. And a SCORE mentor is free. The only thing it's going to cost you is your time. If you're starting a business and you're not using a mentor, one of the things you don't want to have in your business plan is any significant part of luck being a part of your success formula. If you're relying on luck, you might as well consider alternatives like maybe playing the lottery or something, because that involves luck too. Your business plan should not be based in any meaningful way on luck. Potential sources of funding. This is a moving target. I'm going to back up here a little bit. Under normal circumstances, banks don't finance startups. They don't. They're not paid sufficient remuneration in their interest rate to take the risk. They're lending the public's deposit money, and they just can't take significant risks with the money that the loans that they make. I had the duty to write loan policies during my career. I wrote my last bank I was with in Bethesda, Maryland. I wrote the loan policy twice, wrote it once and re-edited it. Both times I had it in the loan policy that no one in the bank can take a loan application for a startup business, because the bank does not do those loans. And if anybody took an application, they'd be called on the carpet and they'd be expected to explain why, because we don't make those loans. So conventional bank loans for a startup are really not a very reliable source. If you have an accommodation guarantor who's worth millions of dollars, maybe the bank will make an exception. I never saw that circumstance in the 40 years I was a banker. There are SBA guaranteed loans, but those are still bank loans. The bank has to decide whether they're going to make the loan or not. SBAC, Small Business Assistance Corporation here in Savannah, they are a development bank, and they have a microloan program. The SBAC has their office at 111 East Liberty Street, where our SCORE offices are in Savannah. They have a microloan program. Their maximum loan, actually, I should update this because during COVID, it's been increased to $200,000 under their microloan program. There are online lenders. You got to be really, really careful, because there are people online that will make loans that are essentially legal loan sharks. They are not very reliable, reputable companies, and they could potentially have you sign documents that could really make your life pretty miserable if you don't make the payments. The most common and reliable source of startup money for a new business is family and friends. Down at the bottom, one of the other options, non-equity crowdfunding. If you do a crowdfunding online, you know who the people are that are going to contribute to your crowdfunding? They're going to be your families and friends. Those are the people that will be your crowd. Because there's not a lot of people out there that are looking at crowdfunding sites and saying, gee, I wonder who I should give my money to today. That doesn't happen. Real world is going to be the best way to start a business is to start small. If you want to start a trucking company, don't buy 5 trucks at once. Start with 1 truck. If you want to start a restaurant, some people have done it successfully by starting a food truck first. Start small. You don't have to raise a lot of money. Get a track record and get business experience running the business to show that you have the skill to do what you want to do. Other potential sources, equity-based options, angel investment from private individuals. Sometimes it happens. It's an option. Is it likely? No, not really for most startups. And venture capital investment is really unlikely. Venture capital companies usually don't go below $500,000 in their investment schemes. And some of them are even higher than that. Some of them are over $1 million. Your best option is personal savings. I will say that if you are starting a business and you don't have any cash from your own pocket in the business, nobody is going to take you seriously about starting your business. You got to have some skin in the game, some of your own money. You cannot borrow 100% of what it takes to start a business and succeed. If that was possible, everybody would be doing it, right? Any questions? Let's talk about credit from the business perspective. Once your doors are open, how does the business obtain credit? Your personal credit is the business's credit. So it's very important that you understand clearly what your personal credit profile is. You have to know your payment history. Get a copy of your credit report. The 5th bullet down there, check your credit score. Annualcreditreport.com. Don't go to any other website. Almost every other website is trying to sell you something. Go to annualcreditreport.com and obtain your credit report. You can also get your credit score. There are 3 credit reporting agencies you can see up top. The names are Equifax, TransUnion, and Experian. They are competing companies that all have the same information. Their credit scores are going to differ. They'll be 10 to 15 points apart from one another, no more than 15 points that I've ever seen. There isn't a difference one to another because they all get the information from the same group of creditors and they post it on their website. Why there's 3 of them, I have no idea. But there's always been 3. I don't know why that is. Your credit score is predicated upon the amount of debt you owe, the length of your history, how many new accounts you have versus credit inquiries, the type of credit on your credit report. If you have all credit cards, your credit score is going to be lower. If you have a residential mortgage on your credit report, your credit score will be higher. Why is that? Because the behavior models say that if you're a homeowner, you're a better credit risk than you are if you are a renter. And that's not to be discriminatory. It's based on data. Homeowners don't default on loans as often as non-homeowners. And that's the data that's in the marketplace. Your minimum credit score, this is also a moving target, but right now, the credit score is 700 to be a reasonable risk for a bank as a lending source. You need a personal credit profile if you're going to sign a lease. The landlord's going to pull your credit report before he accepts you as a tenant. They do that for you individually. They're also going to do it for your business. And they're going to check your credit. So you have to have this credit profile in shape. Right now, it's very difficult to get a loan from a bank for just about anything because of COVID. The thing with COVID that it's come to my understanding anyway, the thing that we all share is the high level of uncertainty in our lives. Before COVID, we didn't worry about what was going to happen tomorrow or next week or next month, did we? Not too much. Now, yeah, we worry a lot. Is my business going to be open next month? Is the government going to shut us down again? All that uncertainty in our lives, school, the effects on kids, our personal health, it's all stress that we never had in our lives before. The uncertainty level also is in the banking community because the banks are being asked to make loans for 2 or 3 or 5 years down the road. They don't know what the future holds either. They're going to be very, very conservative in their lending practices because of that. And right now, I would say that the lending climate is as conservative as I've ever seen it in my adult life. I had a circumstance where a borrower went to a bank with a plan to expand their business. This happened within the last 9 months. And they had a business plan with projections. They'd been in business for 10 years, and they had borrowed money and paid back money to this bank. The bank declined the loan because they didn't think it was the right time to do the expansion. And they didn't think it would work because of COVID. Now, do they know that? No. That's their opinion. I've never seen a loan turned down for a client like that who had the collateral and wanted the loan. It still got turned down. That's the world we're living in right now. Hopefully, with the vaccines and everything, it's going to go away. But right now, getting credit for businesses is a real challenge. Sources of assistance for businesses. We've got, of course, your local SCORE chapter that I'm very proud to be a part of. The National SCORE website, score.org, is one of the best business libraries that I've ever seen. If you want to start a business plan, there are 5 or 6 models of a business plan that you can obtain on score.org that will help you with that. If you need help fixing your personal credit profile, there's an excellent nonprofit agency right here in Savannah. They're out on Water Street, the Consumer Credit Counseling Service, CCCS. There's their website. They will help you fix your credit. That's what they do. Most times, almost all the time, it's free. The U.S. Small Business Administration has, again, an information library that you might want to check out. Local business support groups. There are industry trade groups, the Chamber of Commerce, Savannah Buy Local, the Downtown Business Association. There are about 10 groups in Chatham County that are similar to that. They are all business-oriented to help you market your business. Then you've got the SBDC, Small Business Development. They are affiliated with the University of Georgia. They do very much the same thing that we do at SCORE. They have access to some excellent databases. And we partner with SBDC on a lot of activities. And of course, our host today, the Creative Coast, we partner with them also. Local Chamber of Commerce, as I said, bank affiliations. Your business If you don't borrow, but you have a checking account, you should know somebody in your bank, and they should know about your business. You should sit down and introduce yourself and get yourself a banker. You should also have an accountant. You should also have a commercial insurance agent, and you should have a lawyer. Now, those things are banker B, accountant A, insurance I, lawyer L, bail. You need a bail team. For SCORE, our partners in underwriting our educational efforts for the last few years have been Wells Fargo, Truist, and Regions Bank. We're also expanding that list. I'm currently talking to 2 new potential partners for SCORE for the coming year.